You may have heard the traditional approach of putting 20% down on a home purchase and thinking that that is the best financial decision that you can make. Now, depending on your situation, that may make the most sense, but there are other options. You don't have to put 20% down on a home to qualify for a loan. You can maybe put 5, 10, 15% down, and there's pros and cons to each situation. So we're going to crunch the numbers here to see what might make the most sense for you, and ultimately you can decide. I'm Patrick Rosler with the 513 Flat Fee Real Estate Group at Fathom Realty. Let's dive into the numbers together. One of the main reasons why financial gurus recommend that you put 20% down on a home purchase is to avoid private mortgage insurance, or PMI. This is Freddie Mac's website. It's a government entity. You can use this URL to get to the same calculator I'm going to use to show you the numbers breakdown. Comparing 5% down, 10% down, 15% down to 20% down, so you can understand what your options are. We're going to scroll past those numbers real quick and just look at this basic idea, the definition of PMI, why it's necessary. If you pay less than a 20% down payment on your home, you will have to pay PMI. This is an additional insurance policy that will protect your lender if you are unable to pay your mortgage. So that's why that's required. It's a riskier loan for the lender to make if you're putting less than 20% down. Obviously, the more money you put down, the lower your payment is going to be, the less interest you're going to pay. So, of course, if you could pay cash for a home, that would be better than financing it long-term, financially speaking, if you had that cash to do that. Assuming that you don't have the cash to put 20% down or to purchase a home outright without getting a loan, there are other options we're going to look at here. We're going to look at 5% down, 10% down, and 15% down and compare them to 20% down. Now, you can also get a 0% down loan through the VA or through the USDA. We're not going to cover that here. There's also 3% down conventional loans. There's also FHA loans, which require 3.5% down. Since I'm not a loan officer, I'm not going to go into a ton of detail on all the different options. I'm just going to give you kind of a general idea here, and you can always use this calculator here at this site if you want to look at some other numbers outside of what we're looking at today. I'm in Cincinnati, so median price is around $350 for like a 2-story home in like an average neighborhood suburb. So we're going to use that as a good example, kind of a middle price point on a 30-year mortgage loan. Interest rate at 7.5%, which is about average right now as of the fall of 2023. And then property tax we're estimating at $6,000 for this price point, and $1,200 for homeowners insurance. So, of course, you can calculate if you want to get more detailed here, your specific situation, but this is a good estimate. And we're going to look at a spreadsheet here that's going to compare. This is a visual of the different mortgage insurance premiums and then also the payment difference. But we're going to look at the numbers here on a spreadsheet to illustrate the difference. So on a $350,000 purchase, if you put 5% down, it's $17,500 that you have to put down. There are closing costs in addition to that. If you don't know what those are, talk to a loan officer. We can refer you to one if you're in our area. If you don't have one, that's going to leave a balance of $332,500. You're going to pay 7.5% interest in this example. Monthly taxes is $6,000 divided by 12 months. That's $500. Monthly insurance is $1,200 per year divided by 12, which is $100. The monthly PMI number of 319 comes from this calculator from Freddie Mac. Let's go to MI premiums for 5% down. Now, it also says, I've read other resources that say it depends on your credit score. That's not mentioned here what the credit score they're using. So again, you can get an actual quote for your specific situation from a loan officer. But this is a good illustration to get the general idea of the pros and cons of each down payment option. So at 5% down in this example, you would pay $319 per month in addition to your principal payment, your interest payment, your taxes, your insurance. That's all adds up to your monthly mortgage payment. So speaking of which, your monthly payment would be $3,244. So you can go to the next option. If you were to put twice as much down, 10%, $35,000. Here's your balance. Same other numbers, except for monthly PMI is less because it's less risk for the lender. $3,007. So you're saving $231 there, if I'm doing my math right. Actually, $237 a month. However, you're putting $17,500 more down. 15% down, you can see the numbers here as well. I don't have to read everything out for you, but $83 for the monthly private mortgage insurance. So the breakdown that you want to look at here is the monthly payment difference. So if you're conscious of a monthly budget, of course, most people are, you want to look at which of these is the most affordable for you. And then also over here, which is the most affordable for you down payment wise. You might be in a situation where you want to try to keep as much cash as you can in your pocket. Maybe you want to do some improvements to your house. Maybe you just want to keep it for a rainy day or contingency fund. Or maybe you have a bunch of cash, but you have a fixed income, in which case you might tend towards putting more down and paying less per month. So it just depends on your personal financial situation. The total cash that you spend in year one is a good thing to look at as well. So this is your down payment plus the sum of your monthly payments for the whole year. You can see the formula right here that I used in Google Sheets. Essentially, C3 it's the down payment, and it's plus this payment, which is I3, times 12. So you're spending $56,000 and change the first year, whereas if you're all the way up to 20% down, you're spending $100,000 in the first year. Of course, as you go through the life of the loan, if you're paying a lower monthly payment, you're going to pay less interest, you're going to pay less PMI or no PMI if you're putting 20% down. So your expense from year 2 all the way through year 30 is going to be less if you put more money down. The question is, how much money do you save in the first year if you go with a lower down payment? You can see the numbers here. So this is your cash savings in year 1. Because you only put 5% down, this is comparing it to 20% down. So you can see the formula here, J3 or J6 rather minus J3. So this is this is your total cost for the entire year 1. If you're putting 20% down minus your total cost, if you're doing 5% down, this will be your savings here. So in year 1, you're saving $44,000 by putting 5% down. Now over the life of the loan, you're going to see that it's actually costs more money to do it this way because you're paying more interest and you're paying PMI over a longer period of time. Speaking of PMI, one thing we didn't cover yet is that actually goes away once you get to 78% equity, or rather 78% loan to value ratio if you have 22% equity. So just like if you put 20% down, that would be you're at 80% loan to value ratio. There's no PMI charged. It automatically comes off. If you put less than 20% down, your PMI automatically is removed from your loan. It's required by law to do so. The lender has to take that off once they determine that you're at 78% loan to value ratio. If you're at 80% loan to value ratio, you can request an appraisal. You may have to pay for that to prove that the house is worth what you need it to be worth in order to get to that 80% loan to value ratio where you can take the PMI off. So we're not getting into all the weeds here of the details of how long it's going to take in each scenario to get to that point, because it also factors in the market, how much home values are going up or down. But the general idea here is that your annual PMI, you also want to know you're paying this much every single year until you get to 20% equity. In other words, 80% loan to value. So your equity is how much of the property you own versus how much the lender owns. So 20% equity, once you get to that point, you'll get down to here. You obviously have a dash here because if you put 20% down, you already have 20% equity in the property. So you're paying $3,828 every single year. If you're putting 5% down, you're paying $2,460. If you put 10% down, you're paying $996 a year. If you put 15% down. Now there are some lenders who will offer no PMI. If you put 15% down, that's a whole other thing. You can ask them about that. Now this is what I think is really interesting. If you divide your cash savings in year 1 divided by the annual PMI until you reach 20% equity, you get a number. And this number will be the number of years that it takes to make up that cash savings in year 1. So, for example, when you put 5% down, you're saving $44,000. You're paying $3,800 a year. So it takes you 11.6 years to get to the point where you've actually paid $44,268 in the form of annual PMI. So if you hear somebody say, well, you don't want to pay PMI, so put more money down, that depends on your situation, because if it's more valuable to you to keep $44,000 in your pocket in the first year and pay that over the course of 12 years, for example,
then it might make more sense for you to put less money down. If you have a bunch of cash but you're on a fixed income and you don't want your monthly payment to be this high over here, then you probably want to put more money down. But again, this number here says it takes 11.6 years for you to get to this number here, the cash savings, by paying this much per year, the annual PMI. The next example, when you put 10% down, it's 12 years. So you're saving almost 30 grand, you're paying almost $2,500 every year. It's going to take you 12 years to get to the point where you've spent as much as you've saved in the first year. And then the last one is 15.1 years, so around 15 years. Obviously, these are all dashes here because you don't have any PMI or any cash savings in that first year if you put 20% down. So you can run the numbers here. Again, you can get more specific and more detailed if you talk with a loan officer. Now, I wanted to share one more piece of data with you, which I think is actually the most important thing, which is the total annual cost after year one. So we've talked about the cash savings in year one. We've talked about how much you're paying in annual PMI, but what we haven't talked about yet is the difference in the annual payments you're making based on these monthly payment differences, right? So you can see from here, from putting 5% down to putting 20% down, there's a pretty big difference in the price per month, almost $700 a month. Want to know how much is that costing per year? How much can we save per year after year one by putting more money down? So this is a breakdown of that. Here's your annual cost for 5% down, 10% down, 15% down, and 20% down. So this is where the traditional wisdom of putting more money down is better in the long term, because after year one, you're actually saving quite a bit of money because you're paying not only less in PMI, but you're also, which we've already illustrated how long that takes, which it doesn't seem like just based on PMI, it's worth putting more money down, but based on the fact that you're paying less interest because you're paying that same interest rate on a smaller balance, and you can pay it off quicker, that is actually going to save you quite a bit more money in those annual costs because the monthly payments are lower. So your annual savings the breakdown is here. This is a dash here because if you're putting the least amount of money down, your annual savings after year one, we're comparing it to putting 5% down. So there's no savings there because that's our benchmark that we're using. And if you put 10% down instead of 5% down, you're going to save $28.44 every single year. And then if you put 15% down, you're going to save almost $6,000. And if you put 20% down, you're going to save over $8,000. That is simply just the difference. This number here minus these different numbers here to give you the savings. Okay. So that's your annual savings. The question again becomes, how much are you actually saving? I've got this marked a little bit wrong here. So we'll just change this real quick. This is actually a function of column J divided by column O. So how many years would it take for you to get that money back, basically? Okay, so if you put more money down, we've already talked about it takes 11 to 15 years to get the money you've paid for PMI back. But the overall difference in the monthly payments for your mortgage payment over the course of a whole year, we know the savings now, but how many years does that take to get to the point where you've actually broken even on putting more money down? So at what point is the initial outlay of cash does it actually come back to you? Do you get that return on that initial investment, so to speak? So let me show you how this breaks down. If you look at, we'll look at 20% first. So what we're doing here, if you can look at the formula, is we're taking J6 minus J3. So if we put $100,000 down minus $56,000 down, that's the difference in the total, not down, but your total cash for the first year. So your down payment plus all of your monthly payments that year. So 100,000 divided by roughly 56,000, you're saving $44,000, or rather you're spending $44,000 more roughly. How long does it take? If you're saving $8,200 a year, year two and after every single year, how many years does it take for you to break even? And that number is 5.4. Okay, so again, the formula is the total cash for year one. If you're doing 20% down, let me change that over here one more time because now it just changed. But 20%, the total cash year one for the 20% down option minus the total cash for year one for the 5% down option. That will give you the difference in the amount of cash you spent in the first year. And then year two and afterward, we want to know what your savings is every year, which is right here, and then it'll take you 5.4 years to get that money back. Okay. So that's why a lot of people, the financial gurus, the old fashioned traditional people, which doesn't mean they're wrong, it might be right for your situation, it takes about 5 years. And you can see the breakdown is the same for these other ones. So if you put 15% down, you're going to get that money back basically in 5 years. And the same if you put 10% down. So you can put less money down, just the minimum, the 5% in this example. So you're going to save on the front end quite a bit of money. You're going to save the most cash year one, but afterward you're not going to save any money because that's the most expensive option in this example compared to 10, 15, or 20% down. So again, just in summary, it doesn't make a whole lot of sense in my opinion. Again, you can have a different opinion if you want to just try to avoid PMI. The savings you get by putting more money down is also in paying less interest over the life of the loan. You're saving money every single year, but rather than putting a larger down payment on your home purchase, you could also just, as you make more money later on, or as you're able to allocate more of your budget to paying off your house, you can obviously increase the payment or the frequency of payments, make extra payments if you want to pay that down faster. So that you don't have to pay as much interest. So that's something you can do. Or if you end up moving, then you just sell it and you pay off the balance at that point as well. So this just gives you an example. Within about 5 years, I think the total cost here, it makes sense to put as much money down as you possibly can. But again, you also have to account for if you need a contingency fund. And depending on your cash position versus your monthly income, it might be something you want to talk to a loan officer about to get more specifics on your situation, and talk to a financial advisor too if you're still confused about what's best for you.
So I hope that crunching the numbers has opened your eyes to other options other than just putting 20% down on your home. Maybe you've already decided based on that what's best for you, but if you have questions, you want more professional personal guidance on the best loan options for you when you purchase a home, reach out to us through our website at 513flatfee.com. Click the link there to schedule a call. We'll discuss with you what you're looking for, get an idea of your budget, the areas you're trying to look in, and we'll connect you with a preferred loan officer, a lender that we trust, that we know will give you good advice and let you choose the best option for you based on your personal financial situation. I'm Patrick Grosser with the 513 Flat Fee Real Estate Group at Fathom Realty.